I think that everybody's just a little on edge because the news cycle just keeps pushing the same narrative that we're in a stock bubble, just like we were in 2000. And I get why people are seeing the parallels because we have this completely new technology with uncertain power and unknown applications on how to even use it. So in some ways, it is the same story as .com. Now, I have to say I have a very strong opinion about this, and unlike most people, I'm actually very optimistic. And I may be a little naive, but I see enough differences that I'm not entirely concerned that this is a full-blown bubble. So what I'm going to talk about is some of the points of views that are circling around why this is a bubble. And then I'm going to share my points as to how this is very different. And of course, I'll provide as many facts as I can to support it. And once again, this is merely my opinion based on having experienced the .com bubble firsthand. And yes, I want to state that there's good news, but I'm also the first to point out that there is some bad news with it. When I had worked at Amazon, one of the key tenets was that it's okay to be misunderstood. And from what I see right now, there is a huge misconception about AI. In reality, machine learning has been around for a very long time. I was working on pricing models and machine learning 10 years ago, where Amazon was flooding the internet with bots that were tracking down competitor pricing. And please remember that Palantir, whose stock has been exploding the past couple of years, they're actually 22 years old. What's new is that large language models became visible to the rest of the world, along with access for the rest of us. The backbone of the technology isn't necessarily brand new, but it is evolving very quickly. Now, I've seen a lot of different YouTube personalities lately who have huge followings, and they've been posting videos nonstop about how we're definitely in a market bubble. And their lack of facts really bothered me. For starters, several of them showed this type of diagram where each company is growing because they're buying from each other, and it's built on a fake foundation that's going to crumble on down. And they're also pointing out how several of the companies are reinvesting into one another. From my point of view, that simply isn't the whole truth. Yes, it's true that these companies are buying and selling to one another, but that's not new, and they've been doing this for years. Where all of that purchasing from one another happens to be extremely small percentages of the overall pie. Yes, it's true that they're all buying from Nvidia, but many are creating cheaper knockoffs on their own. So yes, Amazon buys advertising from Google. Well, at least they used to. And Oracle runs on Google, Microsoft, and Amazon. But they do this because it's a product or a service that gives them added value to their own brand offerings. Where we, the consumers, are the real source of revenue and profits, because at the end of the day, we're the ones that are buying from all of them. And there was one personality in particular that said the Magnificent Seven make up 1.4% of the S&P 500, but 40% of every dollar invested goes into those companies, making it unrealistically high, or a bubble that's ready to pop. Now first, let me address the part about 40% of every dollar goes into these companies. And that number isn't wrong. In some ways, it's actually worse. The Magnificent Seven represents between 30 to 37% of the entire S&P 500's market cap. At the peak of the .com bubble, the top 7 companies only made up 19%. So that part is true. We are looking at a concentration that's 80% higher than the biggest tech bubble in history. Now, before I scare you off, the difference is these companies actually earned that weight. So yes, the Magnificent Seven are 1.4% of the S&P 500. That's 7 out of 500 companies. And they generate roughly 10% of the index's total revenue. More critically, they contributed 52% of the S&P 500's earnings growth in 2024. So not market cap growth, actual earnings growth from real profits. Now take a step back and compare that to the .com. Fewer than 20% of internet companies were profitable when they went public. By Q1 of 2000, that dropped to 1 in 5. Companies were burning cash faster than they could bring it in, simply to get eyeballs and clicks instead of actually building a real business. So absolutely, yes, the concentration creates risk. Now, if these 7 stumble, the entire index is going to feel it. But this isn't .com where worthless companies got billion-dollar valuations. The market is correctly pricing the fact that these 7 companies generate the majority of the actual profit growth in the entire index. So in this case, the concentration isn't a bubble. It's the result of exceptional execution. The Magnificent Seven generated roughly $2 trillion in combined revenue in 2024. And I'll go ahead and I'll break it down by showing it on one side of me and how that breaks out for each of the different companies. So that happens to be $1.98 trillion, and I happen to be rounding down. But there's an item that matters more than top-line revenue, and that's profitability, because these companies average 25.8% net profit margins. And in comparing that to the S&P 500, it only averaged 13.4%. Now let's talk valuations. The claim assumes a 1-for-1 ratio, that market cap should be equal to revenue. Fortunately, that's not how stocks are priced. Companies trade on multiples of revenue based on growth and their profitability. High margin, high growth companies, they all command a premium multiple, and they always have. The Magnificent Seven trade at a median forward PE ratio of around 27 times earnings. And yeah, that's elevated for sure, but it's roughly half the 52 to 63x multiples that we saw during the dot-com. For reference, Cisco traded at a 200 times forward earnings back in 2000. And it wasn't just Cisco. The average dot-com era IPO traded at a price to sales ratio of a 48.9x. But as for today, the Magnificent trade at around 3 to 4 times price to sales, so it's a 90% reduction from those dot-com peaks. The market, in my mind, isn't being irrational. It's already pricing 17 to 20% projected earnings growth versus 9% for the rest of the S&P 500. These top-heavy companies are growing earnings twice as fast as everyone else, with margins that are twice as high. So once again, the valuations are reflecting our reality. So another major bubble argument that's floating around is all about Michael Burry, who is the same person who predicted the 2008 financial crisis. And he filed a 13F form indicating that 80% of his fund's portfolio is betting against Nvidia and Palantir. So let's be clear about this. Burry's 2008 call was legendary. He nailed the housing market crisis with precision and he made billions. In the process, he earned a fantastic reputation. But that was 17 years ago, and his track record since then tells a very different story. Burry has been publicly bearish on the market since 2021, calling it the greatest speculative bubble of all time in all things. And time and again, he continued to predict these massive crashes that never came. He was wrong in 2021. He was wrong in 2022. Wrong again in 2023. The market kept climbing while he kept shorting the market. So like I said, in a recent 13F filing, he held over $1.1 billion in put options against AI stocks. He claimed that hyperscalers would be understating depreciation by roughly $176 billion between 2026 and 2028. So these hyperscalers are saying they're going to get roughly 5 to 6 years worth of value from these products, and it's going to depreciate over that time. But Michael Burry's argument is that the reality is they're only going to get like 2, maybe 3 years worth of these products. So they're depreciating it longer and getting a better tax savings. But from what I understand from these hyperscalers, they're still using all of their older equipment and they're just maximizing at 100% capacity. But as these assets are getting older, you don't just simply replace them because you can't afford to keep doing that. You just need to reallocate them for different processes that require less lifting. But the reality is they're not going to replace most items until they break because they want to get as much value out of them as possible. And that's why I see a problem with Burry's argument, because Nvidia's data center GPUs aren't depreciating faster than companies are accounting for them. They're being upgraded and replaced in planned cycles that are fully disclosed in SEC filings. There is no smoking gun because these aren't Enron-style accounting tricks. These are standard depreciating schedules that auditors review every quarter. And more importantly, Burry recently deregistered as an investment advisor, which means that he no longer has to disclose his positions through 13F filings. And that's really convenient timing, which is right after his major bearish bets failed to pay off. I have to admit that Michael Burry is brilliant. His 2008 call absolutely proved that. But being right once doesn't make you right forever. Just ask my wife. Unfortunately, he's also such a big enough name that when he announces a massive short position like this, it can completely move the markets. I mean, just think about it from your point of view for a second. How many of you looked at a news article and saw that he was shorting the market and then instantly doubted your position in the market? I'm guessing that happened to a lot of us, which means he is now influencing all of us. And if there's a large percentage of people who reacted on it, that happens to benefit his bet. And at this point, that becomes influence, not just analysis. I mean, in addition to all that, the fundamentals don't support his fraud claims because these companies are generating real cash flow, real earnings, and real returns. Burry is betting against the most profitable companies in history during the biggest technology build-out since the internet itself. So yes, that worked in 2008, but it hasn't worked since. And before anyone says AI isn't making real money yet, that's wrong. Microsoft AI business hit a $13 billion annual run rate, up 175% year over year. Nvidia's data center revenue, $47.5 billion in 2024. That's up 217%. And Meta's AI-powered advertising tools are generating $20 billion annually. And Amazon's AWS AI business is running at multi-billion-dollar scale, growing at triple digits. Once again, this isn't hype. This is tens of billions in actual revenue from paying customers. Now let me tell you why I'm still optimistic about where this is headed. The Magnificent Seven are spending $325 billion on AI infrastructure in 2025, and that's a 46% increase from last year. And I'm not going to speak to all of these, but at least I'll list how they're spending, and it is a big number. Now, from what I'm seeing, this is not reckless spending. This is calculated investments with massive economic multipliers. McKinsey projects that AI will add $13 trillion to global GDP by 2030. For every dollar spent on Nvidia infrastructure, cloud providers earn $5 in GPU hosting revenue over 4 years. In my book, that's a proven business model. That isn't speculation. Now look, I am not saying that there's zero risk here. That 30 to 37% concentration for these Mag 7 means if these 7 companies stumble just a little bit, then the whole market is going to feel it. And if you're 100% in the Magnificent Seven, then you're taking on significant single stock risk, even if the thesis is right. But as I've stated, I have lived through the dot-com crash. I watched companies with zero revenue and negative cash flow get billion-dollar valuations. It was bonkers. And of course, I watched them all go to zero. This isn't the same. These are the most profitable companies in history, generating hundreds of billions in free cash flow during the biggest technology transformation that probably most of us will ever see in our lifetimes. The risk isn't that these companies are worthless, it's that the expectations are set so freaking high that any little misstep is going to get them punished very hard. I mean, just look at Meta over the past couple weeks. If you were to come up to me and ask, hey Brian, are the valuations high? I would say yes. Yeah, they're absolutely high right now. And then the follow-up question would be, are we going to see a correction? And my answer is yes. Absolutely, we're going to see corrections. And I'm okay with it because that's part of the process. It's what we expect in investing, and it's what we would expect to see with the stock market. And those are more opportunities for the rest of us to buy in again. But if you come up to me and ask, are we going to see a full-blown dot-com crash? My response is that the facts don't seem to be pointing in that direction. So for me personally, I don't see it. With the companies that we have today, with the revenue, the free cash flow, and the margins that they're producing, it's nothing like the dot-com era. But this is just my opinion, and it's my take based on living through the dot-com bubble firsthand. What I would like is if you disagree with me, or even if you do agree with me, I'd love to hear your point of view down in the comments. Do you know something that maybe the rest of us don't? I'd love to hear it. As always, thank you so much for watching.